Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, August 11th, 2021, and I'm pre-recording this Trading Places Live for Thursday, August 12th. Currently, futures, a little mixed. Dow Jones futures up 5 points, S&P futures down 1 point. NASDAQ futures down 19.5 points, so their underperformance is continuing in after hours this evening. We'll see whether or not that carries over into the Thursday open. We're going to get into a few things here, but first, let me go through the agenda with you for today. We're going to start off with the daily market recap. Then we'll get into talking technically. I want to go through some industry groups with you. Look at their absolute charts. Some of them setting up pretty nicely. There's one in particular I think we need to be really careful about. So we'll get into all that. Then we're going to go into the sector analysis. I'm going to show you all 11 sectors on an hourly chart, what that's looking like. Then we'll get into the sentiment. Many times I talk about volatility index with sentiment. This time I'm going to go through and take a look at the equity only put call ratio and talk a little bit about what you should be looking for there. Then we'll get into earnings spotlight. A number of companies reporting after hours. Many of the big companies have reported, although there still are some others that will be reporting soon. And then we'll wrap up the show with the three you must see. And these will be three companies that will be reporting on Thursday. So I'm going to take a look at the chart and tell you what I see before we get those reports. But before we get into any of that, let me take you over to Earnings Beats. For those of you who are new to Earnings Beats, I am the Chief Market Strategist at Earnings Beats. And one of the things that we do for our community is we provide a free Earnings Beats Digest newsletter, which is published Mondays, Wednesdays, and Fridays before the market opens. It is completely free. There's no credit card required. You can unsubscribe at any time. I think it's very educational in nature. Also provides some trading opportunities from time to time if you like to trade. Just simply type in your name, email address there in the space provided. Hit that subscribe button. We'll make sure we get you set up. Again, go over to earningsbeats.com. And then just scroll down and you'll see the area here on the left side of the chart. So we'd love to have you. Taking a look at the action on Wednesday, Dow Jones Industrial Average up about 0.6%, up 220 points, 35,500 now in sight. Just finished below that level on Wednesday, but it was a new record for the Dow. The S&P 500 closed at a new all-time high as well, up another 11 points to 44.47 and change. That represented a 0.25% rise. The NASDAQ, however, did fall back a little bit. So as the interest rates have been coming back up, yields have been climbing, we're seeing some of that rotation again away from the growth stocks, away from the tech-laden NASDAQ, and more towards some of those reopening stocks. Mid caps up almost 1%, up about 0.8%. Small caps up 0.7%. So we did get some outperformance here with both mid caps and small caps. Both of these now beginning to trend higher again. You can see the mid caps holding on to this rising 20-day. We're getting that golden cross with the 20-day coming up above the 50. So that is good news. Small caps, we haven't seen the 20 cross the 50 yet, but we did see a close that we hadn't seen in over a month, at a high that we hadn't seen in over a month. So small caps beginning to strengthen as well. Materials, industrials, financials, all leading to the upside on Wednesday. Materials, industrials, financials all had been lagging, but you can see they are now all moving up together in sync. And this is good news because it's now creating more and more sectors that are on buy signals. Materials up 1.4%, industrials 1.3%, and financials up 1.15%. On the flip side of the sector spectrum, we had healthcare dropping almost 1%. So healthcare, which has been a very strong area of the market, took a little bit for the team. On a Wednesday, fell 1%, still above its 20-day moving average. I mean, all four of these groups still look strong, but on Wednesday, we did see healthcare moving in an opposite direction. There was pretty good volume too on that selling. I would continue to watch to see if we can hold the rising 20-day EMA, given that the PPO was at a high recently with this price high. You can see these highs going higher with price action. My guess is it'll be just like we saw about 3-4 weeks ago when we came down to that 20-day, had a false breakdown and bounced off of it. That's what I would be looking for here. Steel was one of the best performing groups, industry groups on Wednesday. And also with the last 2 days, look at the volume coming into these steel stocks, breaking out above the highs that we saw back in May and June. So very good news for steel. A great day in that area, great couple of days in that area. All right, 10-year Treasury yield. Let's take a look at what happened on Wednesday. We saw the 10-year Treasury yield move up early in the day. Then we saw the yield fall back. It held above that now rising 20-day EMA, and we came back up closer to the high by the end of the day. We finished at 1.34, which was down just fractionally, but we did get closer to the high than we were to the low by the end of the day. That was good news. And I think that recovery helped the financials. Financials continued to outperform, had another very, very nice day on Wednesday. And until things start to change with the yield, till you see a big reversal here, I would expect that financials will continue to outperform in the short term. All right. As far as the economic reports go on Thursday morning, we do have initial jobless claims coming out, as we always do. The expectation there is that we're going to continue to improve. Last week, we saw 385,000 initial jobless claims filed. This week, we're expecting 378,000. So slight improvement, a couple percent. July PPI and core PPI will be out in the morning. Now, we had the CPI out on Wednesday, and it was about as expected. So we didn't get that headline number, that scary headline number that we've been seeing in previous months. So the CPI came in as expected. The PPI for July expected to come in at 0.6%. Core PPI expected to come in at 0.5%. Both of those numbers down considerably from what we saw in June, where both numbers came in at 1%. So we are expecting the number come back down. I will, just wait and let's see what happens when the report comes out in the morning. But the way the market's been trading, it's trading as though it's not worried about inflation. So even if the number comes in above expectations, I'd be surprised if the market were to have any kind of a major sell-off, just based on what I'm seeing in the market right now. I do think that we're probably, setting up fairly soon for a pullback. I'm beginning to think maybe it's going to be in September when we normally see it, but I'll continue to watch and keep you posted here on that. All right, moving on. We've got a lot to go through, so let's do talking technically next. Wanted to go through and show you some of these industry group charts that I thought were interesting. So first, let's take a look at furnishings. The reason I like furnishings, we had a double bottom in here, and you see this high in between these two lows. If you get back up above that high, that essentially confirms this as a fairly significant bottom. And we did that on Wednesday with furnishings up more than 3%, finally breaking out above this prior high here. And I think that puts some cement on this double bottom that we saw from back in June and July. So furnishings with the PPO starting to point higher, really solid day on Wednesday. I expect we're going to see furnishings move higher over the next couple of weeks. Next up, I wanted to point out the apparel retail. Get some water here. All right. Apparel retailers off of this move to the upside. This looks like a cup that has completed here on the right side. We got that PPO now up about 1.5. But that to me looks like a pretty nice cup off of an extended uptrend, maybe a little sideways consolidation, but a close above 1325 would be very bullish for this group. So let's keep an eye on that. Moving on to biotechs. Biotechs were weak the last 2 days. Of course, healthcare has been struggling. This has been one of the better areas within healthcare, but the last 2 days, not so good, pulling back, hitting that rising 20-day, which has been holding the past couple of months. And you can see the PPO has been rising. So I'm expecting to see biotechs reverse here. This will be something to watch. Next up, this is a very interesting chart for a couple of reasons. Commercial vehicles and trucks, which had been struggling for a few months, really since that May high. But with the transports going up, we're also seeing commercial vehicles and trucks moving up. So very, very big move here. Breaking back up above the moving averages, volume picking up, the PPO going positive. And the other thing I wanted to mention here was on the seasonality. Commercial vehicles and trucks, you can see going into September, October, and November. This is over the last 12 years. So since the market bottomed, this covers from 2010 to 2021. And over these 12 years, you can see September, October, November. These are the 3 months when this group tends to do really well. So I think seeing the technicals begin to strengthen ahead of what generally is a very strong seasonal period, that combination is worth paying attention to, in my opinion. Next up, how about the industrial suppliers? All right, so let's go in and take a look at the industrial suppliers. Again, this is an area that really had been struggling. You can see after pulling back in May, couldn't get back through 500 level. And after moving to a new low in June, we came back up, failed again, right at about this 500 level. So what I'm seeing is maybe a little bit of an inverse head and shoulder pattern, which is a bullish continuation pattern. Rising, left shoulder, neckline at 500, lower low puts in the head, back to the neckline at 500, pulled back into a right shoulder, and now we clear neckline. So this is a group that I think we should be able to see some continuing strength here in the near term. So keep an eye on the industrial suppliers. Next up, how about aluminum? Aluminum. All right, I'm not sure why I keep doing this. Must be hitting a button. Anyway, aluminum really struggling to get through 140, as you can see. That was a reversing candle back in May, went down. Not quite an inverse head and shoulders, but we did have a double bottom. We've already cleared that, so that kind of set in stone, that bottom there. And now we've finally gotten through and broken out above that 150 level. So aluminum looks like it is regaining the strength that we saw earlier in 2021. Next up, this is in the real estate area. This is the industrial and office REITs. Now, what I'm seeing here is a move up, nice little cup, and this little squeezing action over here is the handle as the 20-day and the 50-day come up from underneath. So let's watch this 135 level. A breakout above 135 would be bullish for this group. Just a couple more here. Moving on to technology. And within technology, the electrical components and equipment index got up back in April, May to around this 530 level, came back down, see that double bottom. That's a theme with a number of these groups. Put in that double bottom, came back up. We cleared that recent high between that double bottom at 520. And now recently we've just cleared the highs that were established back in April and May. So this is a group, PPO is looking good. I think this is a group looks pretty strong. The last group I have for you here for the industry groups I wanted to show you is software. Now, software has been moving higher, but I don't like this negative divergence here. So this is now multiple consecutive highs where we have seen the PPO lower on the daily chart. Also, we're up into this 2.5 area on the PPO where we were the last couple of highs, and that's where we saw some more significant selling. So I think you've got to be a little careful looking at the technicals here with software, but this isn't where the weakness or the caution signs end. I want you to take a look at this seasonality chart on software, because if we go back the last 12 years, and again, this is during the bull market, this is during really good years coming out of 2009. So this is 2010 to 2021, 12 years. Look at September. By far the worst for software. So only about 1/4 of the years in this bull market, we've seen software move higher in September. And you can see the average gain for September. The only month that's worse is May, which actually has an average loss of 0.6% during that month. But you can see all the other months much stronger than September. So here we've got seasonality telling us we need to be careful here in a couple of weeks as we move into September. And then the charts themselves are saying, hey, be careful. So if we do get another move higher in software, I would be thinking about protecting myself in some way, either taking profits, moving to the sidelines completely, or if you're in some of these software stocks, maybe think about selling calls against your positions. So that would at least protect you a little bit to the downside in the event that we do go lower. If we go higher, you'll make a little bit of money from selling those options. You will get stopped out of your position, though. So that would be the downside. But it's really about trying to manage risk. I think when you start seeing warning signs, it's just telling you that your positions are a little bit riskier. And so maybe doing something to cut that risk a little bit might be prudent and make a little bit of sense. So anyway, just wanted to point that out. All right, next up, how about we move on to sector analysis? I want to talk to you a little bit about these sectors and what they look like. This is a 3-month hourly chart for each of the 11 sectors I'm going to go through with you. So we've got the XLK here, the hourly PPO above, and then we've got the relative strength on the technology versus the S&P 500. So price action, not looking horrible, just kind of going sideways, but look at what's happening as the S&P goes higher. Technology is not going higher. If anything, it's just starting to move a little bit lower. We just set a record today on the S&P 500, but technology was falling a bit. And so you can see the relative weakness, which has begun here. We are now at the lowest relative level that we have seen since back at the beginning of July. So we're now about 5 or 6 weeks, over the last 5 or 6 weeks, this is the lowest level of relative strength on technology. Just to be aware, that we're seeing that rotation again away from the technology group. Consumer discretionary definitely been downtrending here for a while. This is the lowest we've been since back in the middle part of June. So we're talking about 2-month relative lows here on consumer discretionary. The communication services, hourly PPO not really telling us a whole lot, mostly going sideways, but we've pulled back here. We pulled back, set a new low, bounced a little bit, but for the most part, we're right about where we've been, the last couple of months here, not just kind of going along for the ride versus the S&P 500. Now, industrials, we're seeing a little bit of a difference. Here, we had been going down. S&P's been going up, but industrials had been going down since the beginning of June. Look at the relative strength going down sideways here recently. We were at a multi-month relative low just a few days ago. And now here we come roaring back, not too far from moving to about a 6-week relative high. So industrials definitely picking up. We had been struggling at about this 104 level for multiple days, couple of weeks, few weeks. We did break above 104 and we're setting, new recent highs. That PPO on the hourly chart looks good. Therefore, if we pull back and hit that 20-hour EMA, I would consider buying. All right, financials, the XLF. This one looks even better to me. After moving down on a relative basis, you can see the relative strength building. We are now at about a 2-month relative high, easily cleared these recent highs, definitely trending higher. This yield moving up has been a really good thing. It's been a tailwind for financial stocks. And right now, I would say any kind of a pullback near that 20-hour EMA would represent an entry into financials. Next, consumer staples. Consumer staples been trending higher, but overall, mostly going lower versus the S&P 500. So yes, it's going higher, but it's not going higher at the same clip as the S&P 500. It's actually been going higher at a slower clip, but it did break out recently here in the last couple of days. The PPO, hourly PPO looks good. So I would expect any kind of a short-term pullback, even down to about 71.70 or so. I would expect that to hold. Healthcare. So healthcare had been very strong. You can see on a relative basis earlier in August was leading and was at a multi-month high relative to the S&P 500. That's changed. I think we're probably looking at an A, B, C correction. So we'll probably find a bottom here fairly soon, I would guess. But we'll see whether or not these recent relative price lows hold. Next up, real estate. Real estate's been going sideways mostly for the last few weeks. And as a result, it's losing relative strength versus the S&P 500. So nothing really to report here. Nothing, hasn't been any big breakdowns. It's just taking a little bit of a backseat. Utilities strengthening here over the past 6 weeks or so on an absolute basis. I think overall the chart looks pretty good, although this recent high, we do have a higher price, a lower PPO. So we got a negative divergence on utilities. Wouldn't be surprised, maybe see a little pullback to around 67. I think that would be viable, though. I think this is a group. Probably it tends to benefit in the summer months when the market tends to struggle. So I wouldn't be surprised to see if it does pull back, buyers step back in here. All right, just 2 more to go. Materials strengthening again. So on a relative basis, I like what's going on here. Starting to trend higher. We do want to keep an eye on the dollar. As the dollar rises, we had a down day on Wednesday on the dollar. But as the dollar's been rising, that does usually tend to take a toll on materials and energy on a relative basis. So we just want to be a little careful. This group that sold off was not performing well at all versus the S&P 500 and has now started to come back again. So we're seeing at least temporary lift. We're not seeing that same lift, however, in energy stocks. We've seen a little bit of a bounce off that July 19th low. But since bouncing, we've just been going sideways. So relative strength also going sideways here, really not beginning to show any kind of real serious leadership, at least not yet. So that's a look at the 11 sectors on an hourly basis. Now I want to move into the sentiment area. And I just want to go back here over the last year. At the very top here, what I've done is I've put in the price, the equity only put call ratio, the dollar CPCE. I've set this up as an invisible chart as the type. So you don't see all of the daily action taking place in the CPCE. Instead, these 2 lines, they're overlays. And the overlays are 2 simple moving averages, the 5-day and the 10-day moving average. So that's all you're seeing here is the moving average. And so you can see the 5-day moving average gets up to about 0.6 over the last year. That's been the highest it's gone. And you can see that that tends to mark lows, or at least kind of come close to some pretty significant lows. But 0.6 is really not much of a level. I want you to know historically what the levels are that you want to look for on the equity only put call ratio in terms of a 5-day moving average. So this now goes back, this is a daily chart that goes back the last 12 years, 13 years, 12 years. So all the way back into 2009. So here's your S&P 500. And then here is the CPCE. And what I've done here is I've put it in price under a price indicator. I've again selected invisible style. And then the overlay is a 5-day simple moving average. So that's how you can get this 5-day moving average to print down here. Now, if you look at it, these black circles identify all of these moves where we've gone up to the 0.9 level. This means that there are almost as many equity puts being traded as equity calls. Okay. So this is the put call ratio. If we move up over 1, as we did here, the only time that we have in the last 12 years, that means that there's more individual stock puts being traded than calls, which is very unusual. It's telling us that basically the market is throwing the baby out with the bathwater. The kitchen sink's getting tossed. Everybody's panicking. And now traders believe the only way to go is to buy puts. And that usually marks a bottom. And you can see these 5 black circles here. You can see where it coincides on the charts. These are major lows when you get levels, anything, these 5-day moving averages on the put call ratio over 0.9, that's pretty serious stuff. Now down here at 0.8, I've marked in these green circles. I think these are just lows, but not major lows. They're just lows that you need to be aware of. They're really good for trading. You can see here coincides with that low, this one with this low, this one, this low, this one, this low. You can kind of see it doesn't always mark exactly the bottom, but it's a pretty good indicator from a trading perspective when the 5-day moving average of the put call ratio starts getting up near that 0.8 level, you really should be paying attention. I mean, even some of these bottoms are marked 0.75 here. This low right here is at 0.75. So just think about it as we start moving toward that area. All right, earnings spotlight. So we've got a few companies that reported after the bell. I'm just going to show you a couple here. NEO, they came out, they beat. They were expected to lose 11 cents. They only lost 3 cents. They beat on their revenues. Stock was up about 1% after hours. The one thing I'll just point out on the chart is this AD line has remained very, very strong, which tells me that even though price action has moved down for the past few months, 5-6 months, we are still looking like there are buyers whenever NEO pulls back. So that's a good thing. Next up, eBay. eBay trending higher, but has pulled back just recently. This not too long ago was at a relative high versus the specialized consumer services area. And eBay only matched estimates after hours, 99 cents versus 99 expected. So that's a little bit of a disappointment. Stock was down about 1%. It's failing here at the 20-day, though. I wouldn't be surprised to see more selling ahead for eBay. In this market environment, most companies are beating. I wouldn't be very happy personally with what eBay came out with. One last one I'll show you. This was a really good report after hours. Sonos, S-O-N-O, expected to lose 17 cents. They actually showed a profit of 27 cents. Stock is up more than 10% after hours. So looks like maybe this recent selling might be over, the downtrend. And I'd be looking now for more bullish action out of SONO. All right, let's wrap this thing up with the 3 you must see. And I'm going to give you 3 stocks that will be reporting on Thursday. The first one reports in the morning. So by the time you get this, you may have already seen this report. I'll tell you what, I don't like this chart at all. Baidu, it has been trending lower. The AD line also hasn't been putting in lower lows like price, but it's come down off of that high quite a bit. Look at the relative strength of Baidu relative to the internet stocks. I think that doesn't bode well for the stock. Point here is Wall Street's not impressed, and therefore I'm not impressed. Another stock they'll be reporting on Thursday, this one after the close, this is Disney. Disney's starting to show accumulation distribution line moving higher, even though price is not. Relative strength, not great. So I see some mixed signs here. I'd be a little careful with Disney. I think they'll beat. I just don't know what kind of reaction we're going to get. And then the last one I'll go over here is DoorDash, ticker symbol DASH. Been moving up, sideways consolidating, just breaking out. That AD line's very strong, though. And we're near a multi-month relative high. So this one of the 3 is the one that I would like more heading into earnings. All right, that's it for me. I want to thank all of you for tuning in. Enjoy the rest of your week. I'll be back next Monday for your next Trading Places Live. That'll be over at earningsbeats.com. Make sure you come over and join me then, 9 a.m. Eastern on Monday. Have a great weekend, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.